In December 1989, Japan's Nikkei 225 stock index peaked at 38,915 points, the highest stock market valuation on Earth. It took 34 years and 2 months before that number was reached again. Through the 1980s, Japan seemed unstoppable. By 1989, Japan's stock market represented approximately 45% of the entire world's equity markets, more than the United States and Europe combined. Real estate in Tokyo rose so high that the land beneath the Imperial Palace grounds was estimated to be worth more than all the real estate in the state of California. In 1989, the Bank of Japan began raising interest rates to cool runaway speculation, lifting the policy rate from 2.5% to 6% by August 1990. The effect was catastrophic. By the end of 1992, the Nikkei had collapsed over 60% from its December 1989 peak, and land prices across Japan's 6 major cities began a freefall that would not stop for more than a decade. Japanese banks were left holding mountains of loans backed by now worthless assets. Rather than acknowledging losses, banks kept lending to failing companies to avoid triggering their own bankruptcy, creating what economists would call zombie companies. By 2001, Japan's Financial Services Agency estimated that the country's major banks held 43.2 trillion yen in officially non-performing loans. As asset prices fell, consumers and businesses stopped spending, waiting for prices to drop further before buying. This behavior became a self-reinforcing trap. Japan recorded negative consumer price inflation in 1999 and for the majority of years through the early 2000s, becoming the first major developed economy to experience sustained peacetime deflation in the post-war era. Japan's government launched stimulus package after stimulus package throughout the 1990s, pouring an estimated 100 trillion yen in fiscal measures into the economy. Yet without confronting the broken banking system at the root of the crisis, the money evaporated without lasting impact. The Bank of Japan cut interest rates to zero in February 1999, an unprecedented move in the post-war world, but credit across the economy remained paralyzed. Beneath all the visible policy failures lay a slower, deeper crisis driven by demographics. By the year 2000, 17.4% of Japan's population was over the age of 65, among the highest rates in the developed world. An aging society spends less, saves more, and creates fewer new businesses, the precise opposite of everything a stagnant economy needed to recover. On February 22, 2024, Japan's Nikkei 225 finally closed above its December 1989 record for the first time in 34 years. But the cost was staggering. Japan's share of global GDP fell from approximately 18% in 1994 to roughly 4% by 2023. The 3 lost decades of the Japanese economy remain the most studied and most costly peacetime economic stagnation in modern history, a warning that the world still has not fully learned from.